Hey, good morning, everyone. Marty Mazur here. Saturday, 4th of February, 2023. You're going to get at least a couple of videos this weekend. This one will be the stock market snapshot, and I've got quite a bit to show you, an unusual amount for this particular presentation. I'll circle back sometime tomorrow with our economic update. Also updating what we call our equity market conditions index, and that's just something we do once a month. Probably won't do a video on that. It may be the content for Monday morning's note, though. So I loaded up a bunch of screens. I'm just going to go from left to right and show you what I see. The first one is the daily chart of the S&P 500. And folks, the bulls are looking pretty good right here from a technical perspective. We have a 50-day moving average crossing over the 200-day. That's called a golden cross, and I know some bulls who are giddy about that. Price is above the 200-day, obviously. One thing, though, is that the 200-day is still sloping downward, and that really isn't all-on bullish until it starts sloping higher, and that's not the case so far. We broke through, with strength, the downtrend line, which is also the neckline on my reverse head and shoulders pattern here. And remember how those tend to play out. You break through the neckline, you come back usually and you retest it a time or two. So that would be a not small decline from here. And of course, we sold off ultimately on Friday in a pretty big way. So we'll see how that plays out. But if we come down, test that, or if we just keep floating higher, technically it's just a really, bullish looking setup. When we fold in our momentum indicators, the RSI just titched overbought territory on Thursday, right? And of course, as you know, we sold off on Friday. I'm still going to call this, pretty much the makings of a rising wedge pattern, right? So back to price. This is a flat line. So technically, that is a bearish divergence on the MACD. We have a higher high in price, and we don't have a confirming higher high on the MACD. And if this rolls over, if this sell-off continues and we get a sell signal, that is resoundingly bearish. Okay, so price is looking compelling, broken above, huge key area there, the downtrend line, which we haven't really been able to break like this during this whole bear market. And it did die, at least so far, right at the 50% retracement level. Very typical of bear market rallies, by the way, and I think that's the first time we've reached that level. So selling off of there, would be something that would, give the bears hope that maybe things are about to roll back over. Our base case is still that the bear market's not over. You're going to have to get, decisively above the 62% retracement and with some momentum. And, ultimately, I should say, until we break the all-time high, the jury's still out. But, you can start getting up in here, and even where we are now. And again, it's technically speaking, we have to begin to doubt the bearish narrative. So folks, you know what? I think I'll skip the hourly just in the interest of time today because I've got so much to show you. I did pull up the Qs, the QQQ, the ETF that tracks the NASDAQ index. Okay, so here's your daily chart here. Now, one thing I need to point out on QQQ is that it got overbought on Thursday for the first time during this entire bear market. Now, let me make sure we capture the entire bear market. It also, for the first time, broke through the downtrend line, right, the bear market trend line, and the 200-day moving average. So looking pretty compelling for the bulls, but I've got more to look at as we go. So the VIX below 20 during this bear market, right, has been coincident with, right, when it's really gotten below 20, with a top. And then the VIX spiked up, the volatility got bought, and the market came down. The market rallied, VIX compressed, and then the market peaked, right? We got under there. Think of it like holding a beach ball underwater. Boom, you let go of it, it goes popping up. Market comes down. Market began to rally again. VIX is coming down, got below 20, kaboom. Market sells off, VIX rallies. VIX comes down, Market rallies. VIX hits below 20 right when we hit the top of the downtrend line. VIX spiked a little bit, but then we had a lower high on the VIX, came right back down, and then here we are still sitting below 20 with the market extending above that downtrend line. I believe that this probably is yet another bear market rally. That's my base case, but very open to the possibility that that may be wrong. Clients, what it says to us is the risk reward just isn't positive enough for us to, add risk here and take on more volatility than we're already taking on. Okay, staying with the VIX, I wanted to just do a little quick technical analysis of the VIX. Works the same way, folks. We can run these analyses across to anything that has a price and that trades on markets. Back in here in August, this is where the VIX was compressing. So this is where we're getting down below that 20 line, right? And here we are, here with the big downtrend. Here we are here. That's a falling wedge for sure. That is as well. You can see I've drawn one already and so on. And clearly have one now. Okay, bullish falling wedge pattern on the VIX. Now, just think of the VIX as correlating negatively with the stock market. So notice here you had a little bit lower low, but you had a higher low on the RSI. I've done this with you 1,000 times. So that is a bullish divergence. Quickly got a buy signal on the MACD, and we were off to the races. Test right here that passed, and then we were up. And of course, stock market was falling all that time, right? VIX got overbought, came down, right? Got overbought, came down. Here we are with a falling wedge pattern. Here we are with a bullish crossover and a bullish divergence on the RSI. There you go, right? Here you had pretty much a double top. You had both of these rolling over, RSI in particular, sell signal on the MACD. Boom, VIX drops, stock market rallies. Here we are back November, December. We had that great rally in stocks. The VIX was coming down hard. And then at the bottom, we had bullish divergences in both of these and a buy signal here. Market sold off, the second half of December. And then we had this amazing January everybody's, talking about. But the VIX is really set up to spike here. That's that beach ball underwater, right? Be careful, because when that slips out of the person's hands, it goes screaming higher. And the stock market goes, maybe for lack of a better term, screaming lower. So while the stock market charts are looking pretty compelling technically and looking pretty bullish, under the surface, and we look at volatility, very important to look at, this does not look like the VIX is going to be sustained below that 20 line. And if that's the case, then we've got some corrective action coming in the market. This is the daily rate of change for the S&P 500 all the way back to the Great Depression. Okay, I drew lines at plus 2% and minus 2%. So when that yellow line moves above or below 2%, either on the day or intraday, that's how much the S&P 500 moved. Now, think about it as vibrations, right? Think about it as tremors, shaking something, right? Maybe shake something hard enough, things begin to fall off, things begin to crack, things begin to break. What you're going to find historically, let me make this a little easier to comprehend or to look at. I'll just move this forward to, say, 1970. Okay, so 1970 to current, right? We had the 73, 74 bear market, Nixon's shenanigans, the Arab oil embargo, the recession, and so forth. Came out of that, and see, we had quite an extended period of time of relatively low volatility. In fact, here's the S&P, during that time period. Once we settled down, just kind of drifted around, ultimately higher, into the back-to-back recessions in the 1980s, okay? And then you see that turbulence, right? And you see, the sell-offs in the market, the turbulence that's going on, right? And sometimes you get that big, that real volatility right at the bottom of a bear market or at the top of a bull market. It just tells us that something is probably going to break in one direction or the other, right? And then we had the Reagan and Thatcher era, had a real good time in stocks. Not huge volatility, certain periods, mostly upside volatility. And then we had that black swan. The 1987 crash came off of a low volatility period, but you can see it was starting to ramp up in here. There were red flags for sure if we zeroed in on that. And then kaboom, you had the 1987 crash. You had things calm down a bit. You had your early 90s recession with quite a bit of volatility. And then we just had that long period in the 90s that were just amazing, right, for stocks. But then you can see the vibrations beginning to build up. You had the long-term capital management debacle in 98. That was virtually a 20% decline in stocks. And then volatility never really calmed down. I think we made 55% our portfolios in 1999, but look at all the volatility that was going on. Shaking loose the tiles, that sort of thing of the market. And then we had a devastating bear market when the tech bubble burst, right? This was one of our best periods as money managers because we had a fair amount of global exposure and it resoundingly outperformed U.S. stocks. Then we started to get these tremors, even though the market was at all-time highs. This was showing us, things were shaking. There's potential for something to break, and of course, as we know, it broke lower, right? Here in 2010 and 2011, we get in here, the European debt crisis. We had double-digit corrections in here, virtually 20% right in here. 2014 to 2016, that was like a 16% correction all in. And look at the volatility that was leading up to that, and then during that, and then slightly in the aftermath. Then we get in here in August of 2019 when our PWA index rolled over and we started hedging portfolios. Things were beginning to shake up, ironically, right at the same time. Market continued to melt higher. And then, kind of that COVID black swan, I guess, hit right in here, right? Then you had that huge, intense volatility. We got that monster rally coming out of COVID, and things kind of calmed down. It was mostly higher, but volatility waned. Now we're living in a period of intense volatility. Call it turbulence, call it what have you. This is not a good-looking EKG, let's say, at this point. So it definitely says, be wary, have some hedges on. Don't be all stocks. I've got to keep harping on this one. This is S&P 500's aggregated per share earnings. This is our leading economic to coincident economic indicator. And folks, this has never happened without a recession, right? And this has never happened without a significant fall in corporate earnings. And the price of the S&P, as you've noticed of late, has performed really well. And it's acting as if we're not going to have a big, massive earnings recession. Maybe big, massive isn't the right way to characterize it. That remains to be seen. But to think we're going to get out of this alive without earnings coming down, you got virtually no historical support for that when you have this kind of look in these particular indicators. So another reason not to let the pigeons loose just yet on this rally in stocks. So, tech is just screaming ahead, right? Well, let me read to you from this week's Bespoke report. They do a nice report each week. U.S. equity market performance this year can broadly be characterized as a dash for trash. It's the stocks that were down in 2022 that have been the single biggest gaining decile with an average return of nearly 40%. By contrast, last year's biggest winners are actually down this year by 1/3% year to date. Stocks that were further below their 200-day moving averages at the end of last year have been the best performers in 2023, with the most oversold names being up 39% year to date. Amazing. Stocks with the lower market caps and the least positive analyst ratings at the end of last year have also seen big gains. Finally, we note stocks with the lowest international revenue exposure perform the worst, while the dollar's decline this year has boosted those with large overseas revenue streams. Get this one, stocks with high short interest, and I've been talking a lot about short covering, have also been spectacular performers, with the most shorted 10% of companies up 36% on average. Folks, that last one right there says something about the nature of the rally so far this year. So on your screen is XLK. It's the tech sector ETF, tech companies within the S&P 500. And this is when the tech bubble burst, in the early 2000s. So what I wanted to point out is that early in the process, we were down 29%. NASDAQ was down over 30% last year. And then kaboom, a 24, call it 25% rally off the low over a very short, must have been about a month or so. So sounds familiar, right, with what we're dealing with right now. Everybody's talking about the January effect, the third year of the election cycle. But what the bulls aren't telling you, of course the bears are, is that it was the best January for tech stocks, or for the, say, the NASDAQ 100 index, since 2001. Well, here it is, 30% bear market rally turned out to be the worst of bull traps. People got sucked in and they got devastated, only to bottom in March of 2021 and get a 39% rally, only to fail. And then you come out of that, and I'm sure people are saying, look, we're getting higher lows. That's what Bespoke is saying this morning. Well, then kaboom. Now you're in September of 2001. Gotta be over, right? Has to be. 40% rally. Not yet. Not until the fall of 2002. For the S&P, it was March of 2003. But not before the fall of 2002 was this disaster over with an 82% decline in tech stocks. And now the question is, was that the best place to be during the next bull market, right? The answer is, while they did bounce very nicely and led for a while, the answer is resoundingly no. So here's your ensuing bull market that began in March of 2003 for the S&P and petered out in November of 2007. And the gray line is tech. So look where tech fell in terms of sectors. Now remember, tech was the darling of the 90s. It was the disaster of the early 00s. And coming out of that, it paled in comparison to things like energy and REITs and materials and industrials and these other kinds of things that we have up here. We expect notable outperformance going forward during the next bull market from your more industrial type stocks, parts of the world that produce the metals and so forth that the, for example, renewable energy complex is going to need going forward, but just things that reflect a higher inflationary regime for quite some time. We'll have some tech exposure, but tech, odds strongly suggest, will not be the darling of the next bull market. Probably need to continue to pound the table on this one. Goldman Sachs's financial conditions index, when it goes down, financial conditions are easing, and when financial conditions are easing, the risk of inflation rising is rising, right? You just look at the arrows. We've done this before, right? Jerome Powell. So I said on Wednesday's Snapshot, or I alluded to the fact that I thought he would come in hawkish, but I said, I have been wrong before relative to central bankers' conviction, and I was wrong again. He sounded hawkish, he tried a little bit, but he used the word disinflationary several times, and he actually said that financial conditions have been tightening a lot. He really suggested that they're tightening as he was speaking. The stock market loved it because we all know conditions are loosening, and that ultimately that's inflationary. And the Fed chairman himself is saying that they're actually still tightening. Bloomberg's financial conditions index. This one, when it's falling, conditions are tightening. And as you can see, this was, when this was 2008, the economy is rolling over and inflation is dropping below the floor as well, right? So tightening is what the Fed has been trying to do to reduce inflation. Of course, the 2020 shock was a tightening experience. In a tighter financial condition setup, that just means that there's less liquidity, money's more expensive, harder to get. It's not easy money, it's harder money or tighter money. Therefore, it has an impact on economic activity. So here is economic activity significantly easing. People could legitimately say, what was he smoking? We know the conditions are loosening, and we know that's inflationary. And he said they're continuing to tighten. Well, apparently, the Fed is looking at a very narrow range of indicators. Apparently, Lael Brainerd cited some things here a week or so ago and gave kind of a dovish tone with regard to where she thinks inflation's going. For lack of a better term, they've cherry-picked certain data points to say conditions are still tightening and that it's working and they're doing their job. The problem is that they're setting themselves up, if indeed they're not properly signaling to the financial markets the risk out there because they don't want the financial markets to roll over. It's an inevitable foregone conclusion that they're going to, because when people start screaming bloody murder because inflation's coming back, the fingers are going to be pointed firmly at the Fed, and they're going to go back to that very hawkish stance, and they're going to do some serious damage to the market. So to just finish up, what I thought I'd do is just take a real quick, easy peek at the top 4 positions in the S&P 500. And because, again, we're looking at the index, both the NASDAQ and the S&P, breaking through the 200-day moving average, breaking through their downtrend line, and so forth. Well, let's look at the biggest components, and make no mistake, particularly in the NASDAQ, there's a ton of concentration in these. So starting with Apple. So Apple looks pretty good, right? They've broken above the yellow line on this one is the 200-day moving average. Tested it the next day. The October candle during the most recent high previous to the one on the intraday high on Friday looks just virtually the same. You know, little higher wick. This one closed a little lower, but it hit exactly the same level on a big ramp up on really impressive volume, right? Same look here on Friday, right? So for what it's worth, that's just an interesting parallel, right? Because you can see we corrected here pretty substantially. The other thing to point out about Apple is, here's its bear market, right? 29%. Talk about bear market rallies. It rallied almost all the way back, right? I mean, that was huge. I'm sure, Apple bulls here thought the ball game was over, but of course you can see what's happened here. So Apple's chart does look good. Don't get me wrong. And, you could say a good chance that we're going to break above that, and Apple's continuing to be off to the races. It's interesting where it stalled out and the look of the action there on Friday. So Microsoft, not a bad looking chart. The yellow is the 200-day moving average. And notice here we did break it, right? And then failed. Strong resistance, broke above it again here, but not quite as convincing yet as the overall index. Next up is Amazon. Not quite as compelling. So we broke down here, had a significant decline. There's your bear market. Broke above the 200-day, lost it quickly, resisted it there, and Friday it was rejected noticeably. And that is resoundingly bearish, at least on a short-term basis. And then lastly, we'll take a look at Alphabet or Google. Once it lost its 200-day moving average here last year, it hasn't really even threatened it. Well, with this big ramp up here, it did. But then you can see on Friday, it closed at 104.78. The 200-day moving average is 104.79, actually 104.785. So folks, I know that was a lot. Just to kind of sum it up, we have, good-looking short-term technicals in the price chart, some real ambiguity in terms of momentum, overboughtness, that sort of thing. Very volatile with the rate of change on a daily basis. A lot of tremors in there, a lot of vibrations, could shake something loose, and we could have something break, but that break could be in either direction. Corporate earnings, real precarious right here in terms of the setup going forward and what that means for stocks. I showed you bear market rallies in the past that suddenly you look at this and say, oh my gosh, there's no reason to think, based on history anyway, and of course history does not always repeat, but historically it's not unusual to get big rallies like we did in January and still be in a bear market. We looked at financial conditions, which says that the central bankers really were trying to give a softer message amid higher inflation, and that either is wishful thinking or maybe they're getting it right. And then looking at things like the top positions in these big indexes that everybody focuses on so much, and just drilling down one level and saying, okay, what are these components saying? So folks, again, jury's still out. We're not there yet. If we get a 20% bounce, people will say it's a new bull market. But as you can see, there's been lots of new bull markets amid some of the big bear markets of the recent past that didn't turn out to be, meaning they weren't bull markets yet. They were just bear market rallies. We don't know for sure. That's where we're leaning. You'll get more evidence as to why we're leaning that way when we do the economic update here later this weekend. And I'll let you go. Thank you, folks, as always, for watching and listening. Be back shortly. Bye-bye.